Good afternoon, class. We will be recording a series of 15-minute class lectures, which will constitute the entirety of our February 18th class. I would ask that you listen to each one and also do the assigned homework problems. And of course, email me for this class if you have any questions at all. We'll be focusing much of this class on Chapter 4, which begins to introduce the concept of accrual accounting. We've chatted a bit about the matching principle of matching expenses with revenues, and this class moves forward into the notion of how we do that when we don't otherwise have an invoice on hand for an expense, or we may not have otherwise sent an invoice out for selling some of our product. Let's move ahead. There are two main types of transactions that exist in the world of accounting: explicit transactions and implicit transactions. Explicit transactions are just as you see on the page. There's observable events which help to show that the event happened. You received cash, i.e. a cash receipt. You paid out cash. You sent out an invoice when you put one of your products on a UPS truck to ship out. Those are all specific events for which there may be a piece of paper, an invoice, a check, a receipt of some kind, which show that the transaction happened. As the second bullet point goes on to show, there'll always be, or should always be, some type of source document to tie out to, and that's the example of the invoice, the credit slip, the check. Implicit transactions, on the other side, do not generate source documents or any specific type of evidence that showed that the transaction occurred. They are recognized in an accounting period when the matching principle should trigger that there's some matching of revenues and expenses. Some examples there: depreciation expense. In explicit transaction for depreciation expense would be when we originally purchased the desk or the computer for our business. There was an invoice, there was a check. The journal entry that we recorded at that time was to debit or increase our fixed asset equipment account and to credit or decrease cash. The implicit journal entry for that account then would be the depreciation expense that we record each month to depreciate that asset. Similarly speaking, prepaid rent. In the very first month where we make that prepaid rent account, it's an explicit transaction, and then implicitly each month thereafter, we begin to expense that prepaid account. Moving on. With implicit transactions, at the end of each accounting period, which most often is a month, may at sometimes be a quarter, and also could be on an annual basis, that's when that accounting entry is made. You make a specific journal entry. So for prepaid rent, you're making a specific journal entry in your accounting system to debit rent expense, i.e. increase the rent expense for that period, and credit prepaid rent. So take the money out of, effectively take the balance out of prepaid rent. And that's an entry that's going to be made again on an annual, quarterly, most often a monthly period. Those are also referred to as adjusting entries. Any of you that may interact with your accounting functions or the accounting departments in your organization may know that they're doing their closing the books process at the end of each month. That's the process that they are accruing certain assets or liabilities to be able to effectively put them into the right period. And we're going to get into some of the details of what that might happen. But absent making those proper adjusting entries or accruing those proper assets or liabilities, inevitably you will have some account or accounts that are understated and others that are overstated. And of course, the heart of quality financial reporting is that we avoid that from happening. So adjusting entries always affect both an income statement account and a balance sheet account. If you think about that prepaid rent, you're decreasing prepaid rent, affecting the balance sheet, and you're recording the rent expense for that period, i.e. affecting the income statement. Similarly, for your depreciation of your equipment or computers that you bought, you are increasing your depreciation expense for the period, i.e. the income statement, and you're also increasing your accumulated depreciation for that period, or as of that period, i.e. your balance sheet. They're not going to affect cash. If they affected cash, they would be an explicit transaction. So by definition, an implicit transaction is one that does not have a direct impact on cash in that period. Later on, it might. And as we said from the get-go, the fundamental purpose for making these adjusting entries is to be able to, A, have the matching principle be sound, match revenue and expenses in the period to which they relate, and B, avoid misstatements of our balance sheet or our income statement. There's 4 different fundamental types of adjusting journal entries. We're going to go into the details of each 4 of them, which are labeled A through D on this page. The expiration or consumption of unexpired costs. Sounds like some complicated wording, but fundamentally it's really costs that expire due to the passage of time. The prepaid rent expense and the depreciation of equipment are classic examples, right? We recorded the prepaid rent when we prepaid 3 months of rent on the day that we did it. As the passage of time goes on, we're matching those costs or rent expense with the actual 1 month, 2 month, or third month period to which it relates. So that explicit transaction, when we paid the check for our prepaid rent, happens in the past, and then thereafter we are going to match those costs with the right period that they relate. And here's that exact example. On January 1st, a company pays $6,000 in rent for the period January, February, and March. At that point, they're paying out cash, i.e. crediting it, decreasing that asset of cash, and they're increasing the asset of cash for prepaid rent. That was on January 1. Now the end of January comes, and the organization is making adjusting entries to its books, and they need to record 1 month of rent expense, which in turn decreases that prepaid rent account. So if you think about at the end of January, that prepaid rent account was initially increased by $6,000 on January 1st, subsequently on January 31st decreased by $2,000, which leaves a $4,000 balance in that account, which if you think about why, you still have prepaid February and March rent expense, which totals $4,000. You also have a proper $2,000 of rent expense at the end of January. If you didn't properly record that entry at the end of January, the rent expense for $2,000 and the prepaid rent for $2,000, assets, your prepaid rent account would be overstated by $2,000, and expenses, your rent expense account, would be understated by $2,000. So if expenses are understated by $2,000, that then implies that net income is overstated by $2,000. So this is a precise example of the rationale for recording that entry helps us to avoid a misstatement or an overstatement of our assets and hence an overstatement of our net income. An important process at the end of each accounting period. Second area deals with earning of revenues received in advance. We talked about this a little bit when we started talking about the notion of deferred revenue a few classes ago. If you ship out a product, or if you are a vendor of some kind, software might be an easy one, or Let's say you are the landlord that's renting an apartment to someone. And if you receive cash in advance for goods that you'll deliver at a future period, that's not earned revenue because you haven't delivered and promised on that future period yet. That's deferred revenue, which is actually a liability account. And that requires that you record the cash properly on the day you receive it, but also record a liability, which is called deferred revenue, which implies that in some future period, you have an obligation to be able to fulfill in order to recognize that revenue. And we'll give an example in a second. So what are the characteristics of deferred revenue or unearned revenue? There's an explicit transaction that occurred. In this instance, you received some cash, but yet you had not yet delivered on your promise for what that cash related to. But the fact that you received the cash, you received a check, that's an explicit transaction. Subsequently to that, there'll be some implicit transactions that happen, i.e. when you deliver on your promise for whatever good or service it relates to. That's an implicit transaction. There's no specific paperwork that's showing that it happened, but the passage of time would allow you to do it, and in turn, you'll record the revenue. If we do an example, think back to the example we just gave on the prepaid rent, rather than the landlord, or excuse me, rather than the tenant, you're actually the landlord. You own the building. And on January 1st, someone paid you $6,000 in rent for the period January, February, March. That occurred on January 1st. If you think about the entry, you received cash, right? So your cash is going to debit or increase by $6,000. They haven't had that 3-month period lapse yet. So that is an unearned rent revenue, could also be called deferred revenue of $6,000. At the end of January, what happens? That unearned rent revenue or liability account is going to decrease by 1/3, and hence $2,000. And the offsetting credit to that, or an increase, is your rent revenue. So you've actually had 1 month of rent lapse, and hence you have 1 month of revenue. And we're going to think about that unearned rent revenue or the deferred revenue account, the liability decreasing by $2,000 and the rent revenue increasing by $2,000. If we did not properly make that entry, that adjusting entry at the end of January, our liability account would be overstated by $2,000. We'd still have $6,000 sitting in our deferred revenue account. And likewise, our revenues would be understated. We would not have recorded that proper revenue account for $2,000. And so again, that adjusting entries help to make the implicit transactions related to a explicit transaction at the end of a period in order to make our balance sheet and our income statement properly apply the matching principle and properly state the accounts that we're looking at. We're going to pause here as we're coming up at the end of our first 15-minute session. When we start again, which will be session 2, we're going to start talking about accrual of unrecorded expenses. Thank you.